Hello, my name is Aaron Edwards, co-founder and market consultant of Santos Springs. We offer grain marketing solutions to producers in multiple countries. Welcome to our W2H grain marketing channel. Go ahead and hit the subscribe button. I also recommend tapping the bell so you get future notifications. And if you like what you see, hit the like and share this video with other farmers who care deeply about their grain marketing. If you are a corn or soybean farmer, your revenue depends not only on your production, but also the answer to three simple questions: when, how much, and how you sell. One W, when, two H's, how and how much. Our W2H mentorship provides a clear, concise, and custom approach to answering each one of these three questions for your specific farm throughout the year. Before we start this week's content, it's always important to remember that trading in futures products entails significant risk of loss, which must be understood prior to trading and may not be appropriate for all investors. This commentary and the information contained within should be considered market commentary and reflect the opinions of the author. For those of you watching this with a delay, if you are a U.S. corn or soybean farmer and want to stop being held hostage by market uncertainty, let us teach you how to place each one of your bushels in a grain marketing strategy specifically designed to optimize your farm's revenue. Click on the link and we'll work together to see if our W2H mentorship is the right next step for your grain marketing.
This is Aaron Edwards with Santos Springs. Today is January 13th, 2026. Man, yesterday's USDA report was a doozy, especially for corn. I'm going to keep it short this morning, not because it's not important for what's going on in grain markets, but because two things. Number one, can cover it pretty quickly as far as just a rundown of what happened, and also a little bit of the Band-Aid approach, right? We don't want to dwell on bad news for too long. We'll cover what we need to cover, rip the Band-Aid off, and then help you just turn down the volume on markets and not dwell on it too much this week. All right, and I'll tell you why in just a little bit. But first, let me go ahead and share the screen here. There we go. There we go. All right. So I'm gonna grab a highlighter and go to that. We'll go to yellow. We're gonna start like we always do with the call to action. No action recommended. And you might be saying, well, we had better prices and we fell down. You didn't recommend selling. Now you're not recommending. What am I going to do? Throw your hands up in the air, and I'll walk you through the thought process on why there is no action recommended this week in just a little bit. But first, just almost like a rundown of what happened and where we're at. For both corn and soybeans, on yesterday's report, there was an increase of around 1 million acres on harvested acres for both corn and soybeans. That was out of left field. That was not expected. In the case of corn, in addition to that really big increase on harvested acreage, there was also a 0.5 bushel increase to yield. So production for corn just went absolutely, it grew way more than anybody was expecting. What's interesting, and that's the second point, is that the trade estimates on demand were actually pretty close. So we were, if we think about it, in global numbers, a lot of times use million metric tons, right? The trade estimate, expectation of trade was that there would be a reduction to ending stocks of corn between 6 and 7 million metric tons. So ending stocks for corn will come down. Why? Because there has been strong demand for corn. Okay, since there's strong demand, ending stocks are going to come down. Probably a friendly report. Then the USDA number on that just boosted production, almost the exact same amount as what the increase to demand was. So, okay, they acknowledged that there was demand, but then they boosted acreage, boosted yield, so the carryout was unchanged, and that was something that the market was not expecting. And then on the global level, this was probably the most bearish number, in my opinion. On the global market, the corn ending stocks increased by almost 12 million metric tons. For perspective, Argentina raises about 50 million metric tons. So we're talking about an increase to global ending stocks of more than 20% of Argentina's entire production. It's a really big number. It's a really bearish number. One just little bit of information that's not exactly tied to the USDA report, but in my opinion it is interesting, is one thing that we did see on this report was we saw corn fall a lot more than soybeans. So when corn fell more than soybeans, that ratio, it got back to basically, if you remember, right, in my opinion is that the normal range for that soybeans divided by corn on new crop, when we're talking about battle for acres, that's the normal range is 2.3 to 2.7. Some people call that a 2, and I guess I have this as a comma. We got my decimals messed up, but some people say the normal range is 2.4 to say 2.6. I say 2.3 to 2.7 is acceptable, but you can see when we got that adjustment, we're down close to the extreme of that ratio, which we're not all that far from March and the battle for acres, and that might be a story. Now let's shift through kind of the rest of the facts. So we're going to go here. Market plan. The main reason that there's no action recommended is because if you've been following the recommendations, we have calls out to March. We've taken care of our Q4 bushels. They're on basis contract. We don't need to lock in futures at the worst prices, and we have time to lock in futures on against the March contract. We're not up against a timeline, so we can wait based on the strategies that we've implemented. So since we can wait and we're at the worst price in months, why do we need to hurry up and lock in futures? And then the second part of that is maybe we should be locking in basis. Well, the basis market does not react as fast as the futures market. So maybe we will start getting basis improvements and maybe basis contracts will make sense. But that's probably something that will have somewhat of a lag or a delayed effect. That's probably headlines for next week. So in a nutshell, that's why no action's recommended. But that's based on our plan. Then we're going to look at seasonals. Seasonals are friendly corn. The position of the funds, and it'll be interesting to see what happens on Nick's report, but finally we got caught up. They are basically neutral on corn. And then technicals got punched in the gut on the USDA report yesterday. So we'll take a look at that, and that's kind of the central question of this video. Is this a trend shift that we're going to be pressured for a lot longer, or is this just kind of can we expect a V recovery out of this? So those are some of the things that we need to be covering here. So let's start here with soybeans. Let me grab a marker and we'll go over the position of the funds. Good news, although it pales in comparison to the bad news. Where's the marker? Let's see. Red. Let's go with green. There we go. The good news, although it pales in comparison to the bad news from the USDA, was that we have the position of the funds. And this is actually corn. We want to back up a little bit. Let's go to soybeans. There we go. Get the marker black. Okay. So the soybeans, if we just look at what happened, we started getting positive in early October. Then speculators really started buying, got up to 230, and then now they've come back down. So speculators, the spec funds, as of last Tuesday, before the USDA report, they were still long, but just a hair over 50,000 contracts on soybeans, which was down considerably from their highs when they were up at 230. So we finally get a good picture of that soybean. It was just a speculative led rally. They started buying in October, they bought through November, and then they came down out of their positions. And that's that. We saw that in prices. I'll pull up the March contract. We could see clearly how that panned out in prices. Let's get the black again. It's there. Okay. So Mid-October, they start buying, then it gapped up here, got the gap. By mid-November, they were up over 230,000 long contracts, and then now down here, they're at about 50,000 contracts long. That's where they're at right now. Actually, it was as of last Tuesday, so it was in here somewhere. What are they going to do now? And that's the real question, honestly, of this the backdrop after this USDA report is this a trend? And it might be, where this comes down and we really see these soybeans pressured and it's just a bloodbath as we come in to Brazil's harvest. But I'm not fully convinced. I mean, I'm thrilled with the sales we made up in here. A lot of sales made in here. I'm not fully convinced that this market will just roll over. And the main thing is because of these lows. So we'll see, we're right there. But as of the overnight trade, we haven't seen taking out any of those lows. If we do take out this low right here, it probably is a trend that comes down and finds some other support level. Maybe under 10, maybe don't know, but it's looking for support. But as of right now, it's not, those are the support levels it could come down and test. As of right now, it's not, I'm not sure we're even going to go test those support levels. That's on the soybeans. As we look at corn was more dramatic. So this is the spec funds. They got long in December, which was friendly, actually tail end of November. And then they got short. But if you look over the last 6 weeks that were reported, 1, 2, 3, 4, 5, 6. That would bring us here. I mean, we could go to 8 weeks. Over the last 8 weeks, we had 4 long and 4 short. And the average, I've done the math, the average, at least in the last 6 weeks, is like a really small long position. So speculators, before yesterday's report, we'll see when Friday comes out what they did, they were as close to neutral as possible. And if you look at that time frame, it was right here, right? Just absolutely no defined trend. And then this for me is just algorithm trading. Yesterday's bar was, I'm going to say 80-90% algorithm trading. We're a little weak here, and we've fallen so much that you almost have to come see how the market's going to behave around that 410 mark, which was the harvest lows. I'm looking at the March contract. So losing another dime out of this, that's just, we got to see how close we get to that harvest low. Do we take it out? It almost seems like we about have to test that from a technical standpoint. So I'm not saying this market turns around today, but if we don't fall under harvest lows, this is probably a V recovery. Question is, as it recovers and this comes down, does this make the new price range the low 4s? Or can we get a V recovery and can we get our hopes set back up here on these highs like we had them before the USDA report? And that's a trickier question. We have a few more headlines to cover. South American production, will there be further adjustments in the February report? There's, battle for acres in March. There's all of the usual suspects. And man, we are due for just a doozy of a year. I'm also very curious about how basis will behave as we move forward. Will we start seeing basis pick up since the price of Chicago is so weak, or is basis going to be weak, and that'll give us a good idea on what to expect as well. And just to wrap up, let me go over our summary here. Corn. Seasonally, corn is neither a buy nor a sell. Seasonally, soybeans are a sell. The managed money, finally, we don't have those question marks anymore, but it's neutral. It's neither a buy nor a sell for both corn and beans. The trend for corn, absolutely down. Trend for soybeans is down. Oh, sorry, I wrote corn, is down. Trend for soybeans is down. It is a bad day for markets. Now let's go to some commentary here. Basis levels, especially in corn, need to be taken with a grain of salt this week, in my opinion, because basis markets don't react as quickly as the Chicago Board of Trade. Next week's basis levels will be a more accurate representation of cash grain markets than current basis levels. Soybean basis levels maybe are a bit more reliable, but I would probably give them a week as well before evaluating whether it's a trend or not. Technically, corn is in a solid downtrend and looking for support. The next level of support is the harvest lows. The exact price point of those harvest lows varies from contract to contract. As of overnight trade, soybeans have not yet taken out their previous lows. So for now, soybeans are above previous lows, making higher lows. That said, we have just seen a death cross where the 20-day moving average has cut the 200-day moving average, which is technically a very bleak outlook for prices. Wish we had better news. Tried to keep it short today because it's not fun to deal with bad news and bad markets. My honest recommendation is there's no action recommended, so turn down the volume on the radio. Don't go on to those those pricing websites or wherever you really track your markets. It's just let this week go by. Dust settles. We'll take a look at it next week. Markets change. Markets go up. Markets go down. And this was a bad week, but things change. So let's see what future headlines hold, and let's go from there. Hope you have a great rest of your day, great rest of your week.